folks that get in here, they roll their sleeves up, they want to learn every little detail, every intricate nuance that I'm trying to share. It's to make my son better equipped than all of you. Even my students that are here listening, my intentions are to keep my children better than you. But they have to start here too. And this is all useful information. If these are the lessons that you only learn from me, you're light years ahead of everybody else because you're learning to read price action in a manner that no one else sees it like. No other school of thought teaches this way. No one else teaches this way. But by defining things in terms of low resistance and high resistance liquidity run conditions, it affords you a different approach based on whatever day or model or profile that you're operating in. Certain PD arrays are more prone to exist and form in one profile versus another. Reclaimed means what? It's revisiting it. Do you expect that to happen in a low resistance liquidity run condition? Hell no. Elvis has left the building. Goodbye. Right to target. That's what I'm teaching my kids to focus on. That's what I taught paid mentorship students to do. But they didn't want to sit through these types of lectures like this. This is how I taught. Look at the lessons that I was teaching in the first couple months. Conceptual, conceptual, conceptual. Man, is this guy ever going to get to trading? You got to learn a lot of stuff, man. There's a lot of stuff that is a foundational uh, necessity to be able to differentiate easy trading conditions versus a little bit more complex. And the aggressive form of what this is seek and destroy, which it could have created that today. But this is not seek and destroy. This is this high resistance liquidity run conditions. So it comes back and reclaimed order blocks, reclaimed fair value gaps, reclaimed everything. Any PD array that uses its characteristic twice, it's going to be synonymous in high resistance liquidity run conditions. Reclaimed order blocks, reclaimed fair value gaps, in other words, 2 times touching, those generally are going to be part of a market profile like we have here, where it's back and forth, high resistance, but eventually, usually when you're worn down and you're not in the trade anymore, then later in the day, it'll go down and touch the objectives, the new week opening gap high right here. And the first time it gets to it here is at 1143. But look at all this price action sitting here sideways. That'll wear you down. If you're expecting low resistance, real quick, fast, sudden runs, no, you're going to lose your mind. You're going to want to trail stop losses, and it's going to stop you out prematurely. And then you're going to wrestle about why you couldn't hold on to the trade there, or why didn't you see the comments? ICT, why didn't it go down there and hit the new week opening gap right there? Why aren't you taking notes when I'm teaching these things? This isn't the first time I taught it. It's throughout the entire compendium on my YouTube channel. A lot of things that you ask answers for require understanding other things and other facets to the language I've created. And by having that comprehensive view of what it is I teach, it's easy once you have a familiarity of a lot of the things I teach, broad brushed approach, then things that you think are very, very complex and difficult to understand suddenly become very clear to understand. Oh, now I understand why price didn't take that relative equal low there yet. Why did it leave these relative equal highs? And why didn't you wait for it to shoot up there? Because there's conditions in the marketplace that are going to promote a different approach to taking trades in that specific environment. And it's defined by high resistance or low resistance. And it's very easy to notice it. Even if you don't expect it, but you start seeing signatures in price action, how it's behaving, where every individual candlestick is overlapping the previous candlestick's range by the majority. That is indicating the clearest, most visual clearest, most visual representation of a high resistance liquidity run condition is every subsequent candle is sharing the previous candle's range. That's a very simple definition, isn't it? Versus a low resistance liquidity run condition is the candlesticks are a lot more separated between their highs and lows, and they're not sharing much of the same range of the previous candle. It is a lot of big candles, and that's exactly what you want. You don't want to be in here waiting around forever for your target to get met. You don't want to be waiting for the spread to overcome and move into a position of unrealized profit and holding on to that throughout the entirety of your trade. I don't want to be in trades where I have to wait for my trade to come out of spread or initial drawdown. I don't want to be in trades like that. Look at my trades. When I share my examples to you, they're always showing you what? What are the classic characteristics? Number one, it's quickly running in my favor. My stop losses are never exaggerated. They're never taking on more risk than it's required. And they're quickly moving in my direction. And I'm quickly able to take off a partial or cover my costs. And then I sit comfortably and there it is. And I manage my stop. I cannot do, listen to me now, I cannot do the Mr. Wizard's world of stop loss placement in high resistance liquidity run conditions. Not to the same degree that I do with low resistance liquidity run conditions, because high resistance is already indicating that there's probably going to be an opportunity sometime in that day or that session that manual intervention will come in. That means the real market makers, not the dealers that go out there and try to stay delta neutral. Okay, that is not a market maker. I just listened to another Yahoo that has a YouTube channel. He's an Italian fellow. Um, you he interviewed somebody supposedly that knows the ins and outs of the marketplace, and everything that came out of that man's mouth, absolute horseshit. So when you're talking about market makers, you don't even know who the hell you're talking about. You don't even know them. Okay, they're not dealers. Dealers are trying to be delta neutral. That's what their job is. And when there's a lot of movement and displacement in price action, that is adverse for their business model. That is not what I'm talking about. A market maker is the person, the entity, the facilitator of price, where it originates from. It's not the buying and sellers that's creating the origin of price. Who dictates the first print, the opening bell? You don't. I don't. That's never us. That's never us.